Roughly 18 months ago, President Donald Trump announced the following. This will be the last time, April, that you're going to fill out that old-fashioned, big, lots of pages, complicated tax form. Because next April, you're going to, in many cases, file one page, one card. It's going to be very, very different, very, very different. Fail. It's not different. It's sometimes harder than it was before. It's not a postcard. However, later in December of 2017, holding the Tax Cuts and Jobs Act, President Trump passed the most sweeping legislation in our lifetime, and maybe ever in our lifetime, dramatically changed the landscape of tax reform and reduced your taxes and my taxes and almost everybody's taxes substantially. If you're the type of person that gets your tax return and kind of shuffles it away because it has like this aura, this tax return, right? All these numbers, I don't know what it means. My accountant just told me I need to pay some money. My objective over the next roughly 45 minutes is to dramatically transform that and transform your attitude about your taxes and about your tax return, demystify what's on all of those lines and all of those pages. And my goal is to help you feel a surge of confidence. I got this. I got this. Now, measure up right now to where you are right now. I heard some people talking in the elevator before about where you're at financially, maybe behind on taxes, maybe you don't understand any of this stuff. I realize that I have a difficult challenge ahead. I'm up to that challenge. If you're the type of person that already knows this stuff, I think you'll learn a thing or two more. If you're from Canada, I'm sorry today that this is not going to apply to you. You can leave now, okay? Or you can stay and just learn about how crazy our tax system is. Before I dive in, I just want to make a couple of final remarks. I'm going to make this as easy as I can for you. However, if you're distracted during this message, it's going to make it a lot more difficult for you. So I would encourage you to put your devices away. I'm not your mom or dad. Do whatever you want to. I'm just going to move at a brisk pace, and that's my suggestion. And then finally, I'm delighted to be here. I'm truly delighted to be here. I have 5 kids. Those of you who have kids, you know how wonderful it is to see them grow up and change and make mistakes and transform. And next to having kids, the next most wonderful thing is watching a business grow. And I feel so special that I was in the room where it happened in 2006. I know some of you were teenagers then, I get that. Some of you maybe were just not even teenagers, I get that. It's so I'm so bursting, thank you, with pride to see this organization and what all of you have been able to do with it. And I'm glad to be a little bit a part of it, a little part of your journey, and influence this aspect of your life that maybe you didn't have a class about, maybe you don't know about, maybe you haven't learned much about, but it's part of our lives as American citizens to pay taxes. And so I want to teach you today what all of it means. Does that sound good? Yes. Okay, awesome. This is going to be a meat and potatoes message, so it's not going to be that sexy or exciting, but my hope is, again, that you end up with a lot of confidence, and my apologies to the vegans, a tofu and potatoes message, perhaps. In front of you, you have 2 pages of the 1040, the first 2 pages, and we're going to go top to bottom. First, at the top, you have filing status. Almost everybody files either single or married, filing jointly. There are a couple of other filing statuses. I'm not going to get into those today. I'm going to be around the whole day. If you have questions about anything that I talk about, come find me. Okay? I'll be around all day. I'll be around all night. Those of you who know me well know I nerd out on this stuff. I'm willing to stay up until the wee hours of the morning explaining it to you. Happy to do that. Next is your name, your social security number, your spouse if you're married, their social security number, and other miscellaneous stuff. Next is if somebody can claim you as a dependent. Do you Does somebody else provide for more than half of your support, or do you provide for somebody's support? This is where you would list your kids. This is where if you are supporting an adult parent, you would list them. It used to be that you got a deduction, $4,000 of a deduction for every dependent that you had. That went away with this Tax Cuts and Jobs Act. It's been replaced by a credit, which is the child tax credit. Here's my first trick. How do you like that? You want to know how I did that? Come find me later. Okay, the child tax credit. Okay? So, we're going to learn our first lesson, which is what's better, a credit or a deduction? So, raise your hand if you think a credit's better. Raise your hand if you think a deduction's better. Okay, 80% of you didn't vote. That's usually the safest thing. So, I'm glad to know that most of you don't know. So here we go. Even those of you who voted might not know, I realize that as well. So let's start with credit. So assume $100,000 of income. There's a 20% tax. That's $20,000 of tax. So far, so good? Okay, great. If you have a credit, that reduces dollar for dollar the amount of tax that you pay. So with $2,000 of tax credit, this person pays $18,000 of tax. $2,000 less $2,000. Good? Okay, let's look at a deduction. By the way, this is a business deduction or itemized deduction. We'll talk about those. $2,000 of deduction lowers the income by $2,000. Okay? We assess the same percent tax on it, $19,000, $600 of tax versus $18,000 of tax, leading us to conclude that tax credits are much better than tax deductions. Tax credits, because they reduce your actual tax dollar for dollar, much better than tax deductions. Good so far? How many of you learned something? Say aye. Oh, this is going to be a great session, you guys. Okay, let's move on. Wages, salaries, tips, etc. If you're married to somebody who's a W-2 employee, or if you're an S-corp, therefore you're an employee of your corporation, this is where your W-2 earnings go. How many of you are S-corps? Okay, so you get a W-2. This is where that goes, on line 1. Next section, interest and dividends. Schedule B. If you look at your handout that says the schedules, there's many different schedules. Schedule 1, Schedule A, B, C, D, and E. The new tax law, what it did was it summarized, and so rather than more things being on the first 2 pages, there's less things on the first 2 pages and just a lot more schedules at the back of the tax return. So it could have the appearance of looking simpler. It's really not simpler. But a lot of things are on schedules. So why do we start with Schedule B instead of Schedule A? I have no idea. Okay, but that's what's on line 2, and we just did line 1. So this is Schedule B. If you went to Schedule B of your tax return, you'd find any interest that you received from CDs or from bonds, or dividends that you received from stocks and mutual funds. So far, so good. Great. Next section is distributions. So these are generally for older people who are receiving money from their IRAs. They're receiving pension. They're receiving Social Security benefits. Most, if not all of you in the room are not doing this, but if you looked at your parents' tax returns, this is where you'd see their Social Security benefits, their IRA distributions, and any annuities or pensions that they're receiving. That is not Schedule B, I'm sorry. Schedule B is this section. This is not on a schedule. Just goes right directly to the first page. Okay, line 6, capital gain or loss, attach Schedule D, right? Schedule D. So Schedule D is capital gain or loss. What's capital gain or loss? I buy a stock, it goes up, I sell it, I pay capital gains tax. I buy a stock, it goes down, I sell it, I'm able to take a capital loss. So on Schedule D is where you list out all of the capital gains and losses from your various investments. Not IRAs, because you don't pay tax on those. You don't pay capital gains tax when you buy and sell in an IRA or a Roth IRA, right? Only for accounts that are outside of your retirement accounts. It's regular taxable brokerage accounts. That's what we're talking about here. And you would get a 1099 at the end of the year from Fidelity or from Merrill Lynch or whomever that would list out all of these capital gains that you assume throughout the year. Okay, next section, 7 and 8, is other income. It's a big, broad other income, Schedule 1. So I am going to display Schedule 1 so that you have an idea, because this relates very much to you. And on your first page of your tax return, you see other income from Schedule 1, line 9. So we're going to add up all the things that lead to line 9, and then we're going to subtract all the things that lead to line 22 on this page. So 2 sections. I mentioned line 9. That is the addition of all of the income. This is not a handout. And second section, number 22, which is all of the adjustments to income. So let's get a little more granular. On line 3 of Schedule 1 is business income or loss, attached Schedule C. So if you are not an S corporation and you are a sole proprietor, this is not a handout. Yeah, sorry. This is where your net profit or loss goes. On Schedule C, your accountant is going to list out, this was your 1099 from Vector. These are all of your business expenses. This is your profit from your business. That profit number goes on line 3 of Schedule 1 of your 1040. So far, so good? If you are not incorporated, just a sole proprietor or LLC filing as a sole proprietor. Schedule C. Line 5 is Schedule E, which, as you see on your schedules handout, is from real estate, from partnerships, from S corporations. So if you're an S corporation, this is where your non-W2 distribution goes, right? The W2 went on line 1 of the first page. The distribution goes right here on line 5 of Schedule 1. So we're adding these up, and then we get to line 9, the addition of all these things, and then that goes on the first page of the tax return. Are we tracking so far? Okay, great. Now let's look at section 2, which is we're going to subtract all of the things here. And this is mainly, this is mainly retirement contributions and contributions to HSAs. So if you make a contribution to a single 401k plan, if you make a contribution to a traditional IRA, those lower your taxable income. This is what's listed out in this section. So going back a slide, right, what we saw was line 7 was adding up the additions up to line 9 of Schedule 1, and then 8 is subtracting what's on line 22, right? And that's now we're on, now we can move on to the next line, which is standard deduction or itemized deduction. Okay? One of the things that happened with this new Tax Cuts and Jobs Act is the standard deduction doubled, hugely significant. So let's look at that. In 2019, the standard deduction, which I'm going to explain what that is if you don't know what it is, if you're single, is $12,200, and if you're married, is $24,400. It doubled. So you're either going to take on your tax return the standard deduction or your itemized deductions, whichever is greater. Okay? That's what that line says. Give me the standard deduction or itemized deduction, whichever is greater. Okay? Now there's 4 basic big building blocks of the itemized deduction, which is Schedule A. Who can name one of them? Mortgage interest, very good. So that's a good one. Bing, 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 number 1 answer. Okay? This is not by importance, it's just I knew that I put that as number 1, so good job. Okay, mortgage interest is a big itemized deduction. What's another one? Okay, great. So I'm glad this came up. So business mileage is a business deduction. It's not an itemized deduction. Okay? Business deductions are what are going to go on your Schedule C. It's your business revenue, and then all of the business expenses that lead to your net profit. Those are business deductions. This is different. These are itemized deductions. Okay? Charitable donations, good. So that's another one. Healthcare expenses of business can be an itemized deduction. So I'm going to give you credit for that. If it's high enough, it can be. But there's 4 big ones. So let me share the answer with you. Real estate tax and state income tax. Now what changed with this new tax law is that you used to be able to deduct as much of this as you had. If you had $50,000 of tax because you live in a gigantic house, you can deduct all of that. If you live in a blue state and you have enormous state income tax, you can deduct all of that. The law changed. Now you're limited to $10,000 of deduction for the combination of your real estate tax and your state income tax. This is known as the SALT tax limitation, state and local tax. So if you live in a house and your real estate tax is $8,000 and your state income tax is $4,000, you're limited to $10,000 between those two. And then the last one that was mentioned was charitable contributions. So these are the big 4 that go into itemized deductions. Mortgage interest, real estate tax, state income tax, charitable contributions. Let's give an example. We have a married couple. The standard deduction, who remembers what the standard deduction is for a married couple? $24,400. And let's look at what an array of their itemized deductions could look like. They have $15,000 of real estate tax. They only get credit for 10 now. They have $8,000 of mortgage interest. Now, so far, what are they going to do? Itemized or standard? Standard because it's bigger, right? Okay, you're all tracking, good. What's also true here, everybody pay attention here, the first $6,400 of their charitable contributions, they're not really getting credit for. They're not really getting a tax benefit for. Because if they give $5,000 of charity, they're still going to take the standard deduction because it's going to be greater than their itemized deductions. So this has created a planning strategy called bunching. If you want to grab me later, I can talk to you about it. So standard deduction or itemized deduction, whichever is greater. We're good with that? Great. Let's move on to line 10. Huge, massive impact, qualified business income deduction. Yes, so in 2017, it was around $6,000 for single and $12,000 for married. And the Tax Cuts and Jobs Act, which went into effect with the 2018 tax year, doubled that. Yep, you're welcome. Qualified business income deduction. So what this did is basically give you a business deduction for 20% of the net profit of your business. Think about that. Yeah, qualified business income deduction. So we're on line 10 of the tax return here. Qualified business income deduction gives you a 20% business deduction for your profit. So Donald Trump, obviously business owner, pro-business. This was lowering corporate taxes and taxes on entrepreneurs substantially. So if you have a 1099 that has $150,000 on it, and you have $60,000 of business expenses, including mileage, including all that stuff, and your net profit is $90,000, you get an additional deduction for $18,000. Okay? Qualified business income deduction. So this is huge. The combination of QBI, which it's known as, and the standard deduction doubling saves all of you lots and lots of tax. Now we get to taxable income. So we basically added up all of these things, and now we're down to the taxable income. Well, how do we take our taxable income and go from that to how much tax we pay, which is the top line of the second page of the return. So we're talking about how do we get from taxable income to this is how much tax I'm supposed to pay. And what we do is we go through the tax tables, which you have the tax brackets in front of you. And so if I'm single, the first $9,700 of earnings that I have, I pay 10% on. On the next roughly $20,000 or $30,000 or so, I pay 12% on that. And the next 50,000 roughly, I pay 22% on that. So I want to just pause for what I said because most people don't understand how this works. Okay? Most people that your age roughly and experience, and pretty much if I talk to a general audience, 95% of the people that I'm talking to do not understand how this works. Okay? These are marginal tax brackets. Most people think that if they bump into the next bracket, that all of their income gets taxed at that rate. That is not how it works. It's never worked that way, and it's not working that way today. So let me unpack that. Whatever that dollar amount is that you earn, if you're single, the first $9,700 of it is going to be taxed at 10%. The next slice of your income is going to be taxed at 12%. If your taxable income's over $38,700, the part of it that's over $38,700, that's going to be taxed at 22%, just the slice that's in that bracket. How's that sound? Better, right? Okay, so the bottom line is it's never a bad idea to make more money. Okay? Don't worry that you're going to go into the next bracket. There's not a 100% bracket, okay? We got that clear? Okay, go make some money. All right, so now we're going to give an example. So let's follow along. Taxable income, let's just say, is $94,200. You took everything through, you did your profit, you took your standard deduction, you did QBI, and you land on $94,200. Okay? Let's work the math together. Here's the computation that you have. This part here lets you know, like it's kind of a cheat. It tells you how much you'd pay at that bracket. So it gives us a head start. So basically, what this middle section tells us is, if we land exactly on $84,200, then we're going to pay that much amount of federal tax. But if we're over that amount, then whatever we're over, we're going to pay 24% on the excess above $84,200. Got that? Okay, so now let's take this number 14,382.5 and let's just like picture pages. That was a reference you can look up. Has to do with somebody who's in jail. Okay, his name happens to rhyme with Bill Cosby, and he had a show called Picture Pages when I was young. That was a long time ago. Okay, 14,382, thanks, Steve. $14,382.50. So far, so good? Now, I did this on purpose, right? There's a gap between this number up here, 94,200, and the end point there. And that gap is $10,000. And we're going to pay 24% on just that slice. Okay, 10,000 times 24%, $2,400. So on my $94,200, I owe $16,782.50. Okay? Now, what portion of $94,200 is this? Let's look. Divide by $94,200. Do we get 24%? No, because that's just the slice. That's just the marginal bracket. What we get is 17.8. So in fact, somebody who makes $94,200 of taxable income, they're paying 17.8% on that $94,200. So far, so good? Okay, how have I done about keeping this real? Is it? Yeah, okay, good. Okay, great. So the marginal rate, somebody asks you, what's your tax rate? Well, my marginal rate, which is the rate that I pay on the last dollar that I earned, the highest rate, 24%, but my effective rate or my blended rate, 17.8%. Okay? So far, so good? Okay, great. Now, a couple implications of this. The first implication is, if I'm at a marginal rate of 24%, marginal rate, that means every business deduction that I can find, I'm saving 24% tax. So if I can find $1,000 of business deduction, right, I'm saving $240. Every $1,000 of business deduction I can find saves me $240. Does that make sense? Okay. So what's key is that you have a really good bookkeeper to find all of these things that you can deduct. And then that you have an accountant who works with you and helps you deduct all the things that you can reasonably and mostly legally deduct. Okay? Make sense? Okay, so I happen to know of a bookkeeping company that I might be able to recommend to you. It's called MyBooks.pro. And I'll just tell you a couple things about MyBooks.pro. The first thing I'm going to tell you is that you can sign up personally today for you to be our clients. And just like your best Cutco clients are people who are already, or your best Cutco advocates are people who are your customers, guess what? Same thing for us. But we would be delighted if you would give us a shot to do your bookkeeping. After this session, Robert is going to be in the back, and he's going to be at the table, and he doesn't know that I'm going to offer this, but if you sign up today, Robert, who is an amateur bowler, this is legit, will give you a bowling instruction tonight. And how many perfect games have you bowled, Robert? 21 perfect 300 games. I'm not kidding. Okay? Robert is legit bowler. Okay? Robert is sponsored, professionally sponsored to bowl. Okay? Serious. Okay. So, you want your bookkeeping to be on point. Okay? Now, the other thing that I want to say is that John mentioned to you that MyBooks.pro serves realtors. So, we're also in partnership with you. And as we understand it, when you have your client events and your realtors come to it, if there's financial information, more realtors come. Is that your experience? Great, so we want to partner with you. When you have big events, Robert's going to fly to the event, do something very similar to what I'm doing here. Teach your realtors taxes, teach them how to build wealth, teach them all of those great things. So please see Robert before this conference is over. If you want to sign up, that's great. Okay, we're going to move on. Okay, self-employment tax, because it wasn't enough that we were paying $16,000 of federal tax. There's more tax to pay because we have the wonder of being entrepreneurs. So here's how self-employment tax works, also known as payroll tax, also known as FICA tax. You hear any of these things? They all relate to the same thing. You pay into Social Security as the employer, 6.2%, as the employee, 6.2%. Okay? If you had a business, and for example, if you were a manager and you had a receptionist, they were your employee, you as the employer paid a portion of that FICA, they paid a portion of that. If you are an employee at a company, or if you're an employee anywhere, you pay half, the employer pays half. But if you're self-employed, then you not only get to pay Social Security and Medicare, but you get to pay twice as the employer and the employee. So 15.3% is the amount of self-employment payroll or FICA tax that we pay as self-employed. If you're an S-Corp, it's a little bit different. I'm not going to get into that nuance now, but you basically pay this on your wage, on your W-2 wage, and not on your distribution. Okay, here's our total tax, line 14 and line 15. What we have here is basically how much have you paid in already? If you've paid in, either because you had money taken out of your W-2, if you're S-Corp, or if you've paid estimates along the way, how much do you owe? And then is there a refund or is there tax that's owed? So this section is basically figuring out that computation. Okay? Ready to move on?
Would this be if employees paid quarterly taxes?
Yes, so if you've paid quarterly estimates in, that's going to be figured into this computation. Hey, you owe this much, but you already paid in this much. So this is how much you owe, or this is how much you've overpaid. That's exactly how it works. So there's three things that we can do with all of this tax that I've just described. The first one is lower them, okay? Now that might be the answer, like what if I don't want to pay them? Well, just lower your taxes. So there's two main ways that we can lower our taxes. One is we can have more business deductions, find more business deductions and lower our expenses, right? Get a good accountant who's going to make sure that you get all the deductions correct. And also, like focus on what you can control here, which is contribute to HSA and to your retirement accounts. Because contributing to a health savings account, contributing to a 401k, contributing to a traditional IRA, all of these lower your taxable interest and your taxable income. So far, so good? Okay. The second thing that you can do, there's three things that you can do other than the answer. The number two is use the vector tax withholdings system. I'm a huge proponent. Okay? You can sign up for tax withholdings, and you can have vector withhold a percentage of every check that you earn. You can sign up for 10%, they withhold 10% of your check. 20%, they withhold 20% of your check. If it's out of sight, it's out of mind. And then you don't need to be scrambling in April, like, oh my gosh, I have to pay tax. I haven't paid tax. Where am I going to find this? And then sometimes get behind on taxes, and then you're in a hole, and there's a monkey on your back. It's a spiral, right? All these negative things. So stay on top of it. How you do that is use the vector tax withholdings. And then number three is pay quarterly estimates. Pay quarterly estimates. So when you do your taxes, your accountant will give you coupons or little tickets to pay quarterly estimates. So this is what mine looks like. 2019, fourth quarter, right? Myself, by the way, my first name is Lawrence, if you ever wondered, well, what's the L Adam? My first name's Lawrence. When I got married, I'm a sensitive New Age guy. I hyphenated my name with my wife, okay? So this is my legal name. You didn't know that? Lawrence Prowerstock. That's my legal name. Okay. All right. How about like 1, 2, 3, ah? 1, 2, 3, ah, okay. Yeah, so I asked for that, but the reality is I went to my wife, Melinda. I'm like, so what do you think? And she's like, well, we can hyphenate our names or you can take mine. Okay, Prowerstock it is. All right. So this is my federal coupon, and this is my Illinois coupon. Right? So I pay my estimates every quarter so that by the end of the year, I don't owe this huge honking amount. Now, when do we pay those quarterly estimates? Well, it's not obvious when we pay these. The first one, we pay in April. Well, that's pretty obvious. It's April after the first quarter, right? So when do we pay our second quarter estimate? June. That makes no sense. When do we pay the third one? September. Makes no sense, okay? This is when they're due, though, and there's penalties if you don't file and pay your estimates on time. So it's not that difficult. Booby trap yourself for success. Put a recurring activity in your calendar on April 2nd, every April 2nd, every June 2nd, every September 2nd, every January 2nd. Pay quarterly estimates. Okay? One more thing that I'll say about quarterly estimates before we move on is if you have a huge year, what you have to know about April is if you're on your game, you're going to have to pay two things. You're going to have to pay your underpayment, which is how much you didn't pay from the last year, and you're going to have to pay your quarterly estimate, which is going to be higher than it was the previous year because you made a lot more money, right? Your quarterly estimates are based on how much you earned the year before. So I'm preparing you in case you're having these monster years that you can get way behind and really whipsawed if you're not preparing for what's going to happen, which is that April payment is going to be the underpayment and it's going to be your first quarter payment for the new year.
I pay my taxes quarterly, but let's say someone here doesn't pay taxes quarterly.
Yes. Yeah, it's a great question. It's not completely clear in the tax code what the formula is. So I can't give you a great answer. What I can give you is this answer. There's a penalty for not paying your taxes, and there's a penalty for not filing your taxes, and those are two separate penalties. If you don't file your taxes on time, right, the penalty is 5% per month, up to 25%. If you file your taxes but you don't pay what you owe, like you do your return but you don't pay the money, it's 0.5% per month. So it's always best, even if you're scared that you don't have the money to pay the tax, it's always best to file the return and then build up the money and pay the tax later. Okay? Now, one more note on this subject, extensions. Okay, let's talk about extensions. Extensions are extensions to file, not extensions to pay. Well, what on earth does that mean? What that means is if you're not prepared to file your return on time, you can have your accountant file an extension, but that doesn't just give you free time to pay the money. You have to pay a penalty if you don't make a good faith effort when you file the extension. Okay? If it was an extension to file and pay, everybody would just do that, right? Like, why do I want to pay in April? I'll just pay in October. Okay?
You say 5% of that 5% of the tax liability.
5% of the tax liability.
And my second question is all the other taxes like the capital gains and the dividend and all that, are they taxed at your tax bracket or do they have their own tax?
Aha, great question. So the first question is the penalty a penalty of your how much tax you owe? And that's correct. So if it's 5% or 0.5% penalty, it's of the tax that you owe. Second question was the capital gains tax. Is that at your income tax or is that a different bracket? And the answer to your question is yes. Short-term capital gains are at your ordinary income tax rate. Long-term are at a different tax rate. Short-term is if you buy and sell something within 12 months, that's short-term. Longer than 12 months is long-term. So generally speaking, you're going to pay a lower bracket for long-term capital gains tax than short-term capital gains tax.
Current long-term capital gains, and then did they cap corporate tax rates or flat rate?
Yes, great questions and points. So what's the top tax rate for capital gains tax? It's 20% federal, but you have to be at a high income level in order to pay that. There's also a 15%, and if you don't earn that much, you could either pay 0 or less than that. And then if you're in a state that has state income tax, typically you're paying the capital gains rate at that state income tax rate as well. The second question was, isn't there a flat corporate tax rate? And the answer is yes for C corporations. So none of you are C corporations. These are huge corporations like Microsoft and Amazon. They basically had a graduated marginal rate for corporations, and they flattened it to one rate. And so the QBI was a consolation for all of us who aren't C corps, so that we could get something equivalent to what the big guys and gals got for their big corporate deduction.
On the
What time is it?
W-2
What time is it?
salary
Yep.
versus distribution,
Yep.
how does the S-corp distribution?
Great question. So the question is, on an S corp, you have W-2, and then you have the rest, which is called distribution or S dividend. How does that get taxed? S corporations and LLCs are pass-through entities. And what that means is that they all pass through to your individual return, and they get taxed at those same rates that you have in front of you. There's no separate corporate rates for LLCs or for S corps. It's all individual tax rates.
The dividend or the W-2?
All of it. So the W-2, so if you take $30,000 of salary and then you have $40,000 of distribution, you're going to pay $30,000, whatever the tax on that $30,000 is, and then you're going to pay the $40,000, just as if it's one piece of income. The benefit of going S Corp. Okay, so it used to be that you saved the FICA tax on the non-W-2 piece. So I went over the FICA tax before, the 15%. If you are an S corporation, you only pay that on your wage. You don't pay that on the distribution. So it used to be a nice way to save 15%. However, with QBI, the qualified business interest deduction, is not on the wage. It's only on the business profit. So in fact, now the economic incentive to become an S corporation is not very much at all.
But yet it costs more to use a CPA to file an S corp.
Right, that's right, because you have to file 2 returns. You have to file a business return, and you have to have a personal return, okay? So now you're going to ask me, well, should I keep my S corporation, or should I dissolve? Was that your next question, Matt? Or should I dissolve it? There's stronger legal protection if you have an S corp, okay? So that's one reason. If you have a bunch of assets or a house or what have you, you might want that extra legal protection. Rising Stock, one of my businesses, is an S corp. I'm not changing it, okay? But if you're new and you haven't incorporated yet, you might think twice and go LLC, file as sole proprietor versus S corp. And that's something to talk to your accountant about. Okay? And the QBI may disappear at some point, and then you're going to want your S corp back. So, okay? Can you hang on just one second? I want to just check what I have left. Oh, great. I just have a summary slide. We have some more time for questions and answers. I thought I was at the end of the presentation, but I just want to make sure. Jenny.
So I've been with this kid for like a decade, and I never really paid too much attention to their fees until recently, and I know for about, I couldn't believe like how much they charge.
Yes.
The question is, in this world, do you find like the more you pay, the better they are? Or does it work?
No.
Or am I being off? Like, I'm just trying to figure it out.
No, so the question is, like, I'm paying a lot of money for my CPA. Am I getting ripped off? Are they doing a good job? Am I paying more and getting more? I would say that it generally has to do with complexity. So your businesses have gotten more complex, and that warrants more work. And that work warrants more fees. So I would make sure that whatever it is that you're doing, that occasionally you have a second opinion. You bring your tax returns to another accountant. You don't tell that accountant how much you pay this accountant. You just say, this is the work that my accountant does for me. Can you look at the returns? Can we have a conversation, and you can give me a quote for how much it would be, right? And that way you can kind of keep it honest, right? But if you have an S corp and you have 3 businesses and you have a lot of different things, I mean, I think that I pay $5,000, maybe $6,000 a year, and to my accountant for the various entities and personal returns, and I didn't used to when life was simpler. I paid less. Other questions? Yeah, Lori. And I'll come here. Good question. So the question is, if you own an S corp and you have property, should the property be in its own? And not if it's a residence, but if it's an investment property, we recommend that people have an LLC for each investment property that they own, so that if somebody slips and falls on property 1, they can't sue property 2 through 18 or whatever you have, because they're all in separate LLCs. Yeah.
Can you give any examples of legal loopholes or additional tax deductions that may be beyond what you would typically think of, like anything?
Yeah, so the question is, can I give any loopholes or tax deductions that might be outside of the scope? So I'll give you 3 answers, okay? One is not while I'm on video, okay? Number 1 answer, okay? Number 2, I'm around all day. Have lunch with me. Let's meet up tonight, okay? Number 2, get a good accountant, right? Number 3, have a good bookkeeper. And then I'll also give you some legitimate, right, expenses and what to know about the new tax law. The first thing to know about the new tax law is that there's no entertainment deduction. That went away in 2018. It used to be that you got 50% deduction if you took a client golfing, or if you took them to a basketball game or a baseball game. 0 now. You can still take them out for meals, That's a 50% deduction. But entertainment is gone. Okay? So if you have space in your house that's a dedicated office space, right? Home office deduction. You can't take a home office deduction if you have another office that's outside of your house. You can't take two. And you can't like cobble together your dining room table. You're like, okay, this is my home office, right? The home office deduction is a red flag deduction. So you want to make sure if you're going to take that deduction that it's really crisp. And you can only take the deduction for the percentage of your utilities and your real estate that the square footage of that office makes of your house. Okay? Conferences, travel, professional development, conferences, marketing, gifts, all of those things are all deductions. But I find more people mess up because they're not tracking them than that they don't know what to track, if that makes sense. Tony?
So couple things. I want to help you with call to action here because I think it's important. Not that you need help with it, but I'm going to help you anyway.
Thank you.
Couple things. Real concisely, can you just review in terms of the service that you offer
Yep.
and that you're offering today? In a nutshell, what does that service do for you in general?
Yep.
Because there's different buckets. There's the accountant, and a lot of people are like, oh, maybe it's better than my taxes, right?
Yes.
What is it you do,
Right,
and
yep.
how much does it cost?
Great. So thank you for that. Here, Adam. Here's a slam dunk. Lunges. Perfect. Thank you. Always listen to people who have more kids than you do, especially when you have 5. Okay, thank you for that question. So we're bookkeeping, primarily bookkeeping. We also do some coaching, similar to Rising Stock, except the MyBooks.pro is a QuickBooks Online service. So all of the bookkeeping that we're doing is in the cloud on QuickBooks Online. Super handy. Oh, QuickBooks is like the gold standard for bookkeeping for accountants. So if you let your accountant know, oh, I've got all my stuff on QuickBooks, they'll be like, oh, great. So QuickBooks Online, and it's in the cloud, so your accountant has access to it on a regular basis. They can see it, they can work with it, you can work with them to work with it. There's different service levels. Without going into specifics, Robert has a table outside. After we break here, there's a break, we go to lunch, visit Robert, you'll see the service offering. What we're offering today as the first call special is we normally have a setup fee, right? For all of our clients, we're waiving that setup fee if you enroll while you're here today or tomorrow. And then also you're realtors, right? So like we want to partner with you to be this presentation, financial education for your realtor clients. And then our special niche is working with those realtors.
So to the lady's question up front, like loopholes and so this is the way I look at it. This is not something, the bookkeeping part of your business, this is not something for you to save money and do on your own. This is a very small expense for what you get for the expense. So don't be like, I saw a commercial for TurboTax free, I think I'm fine. This is very important based on what you guys do for a living, okay? And how the report works, and your deductions and your expenses. This is something you need help with, okay? Now, if you already have a bookkeeping service, fantastic. But I know statistically, a huge portion of the room does not. And by using this service with whatever the special is and whatever, you will save more than it costs. So this, in my opinion, is not like, oh, should I do it? It's just like, go sign up and make sure you're doing this, because this needs to be part of your system, just like we tell people to sign up for VAST and use that for your database. So really important that this is happening, because what happens is you start making money and you have deductions and you kind of figure it out for a while, and then after a while, you get to a point of income, and then you show up on tax day and things are fine because you haven't paid taxes for a long time, and then they go, oh, you're going to owe $27,000. And you're like, oh, I don't have $27,000. Plus, not only do you not have that money, you haven't been paying the quarterlies,
Taking the time.
is if you do not, if you are not already using the bookkeeping service, sign up for this today, period, non-negotiable, just do it, right? Because using this interface and make sure it's tied up to QuickBooks and all the rest, it's gonna make your job way easier in a year from now. You're gonna be like, oh, this is just something that's done. It's not this underlying stress that exists in your world. And that's usually what it is. It's like, oh, I really need to, right? And then it's a year later, and it's like, and then it's like, oh, I talked to some reps. I haven't filed in the last 3 years. Wow, that's a lot of stress. That's a lot of stuff to figure out. And you're supposed to be booking your meetings, doing one-on-ones and all the rest, right? So go sign up, and if take in your card, I was going to pass from the box, that whole thing, right? You got a table out front, but make sure you get the information, make sure you get signed up. It's very nominal for what you get for the money. So that's my pitch in terms of the testimony or whatnot. Like, you have to use bookkeeping. You have to pay your taxes. Period. The end. It's not like a negotiable option for you. So go talk to him, because what I liked about this talk is it was very informational and it gave a lot of clarity, but it also was very confusing by the nature of the topic. There's so many tangents and so many scenarios, and so many types of income and deductions, what's okay, what's not okay now that used to be okay, and this and that, all of it. That's not something I want you guys thinking about figuring out for the nominal fee that you can have an expert take care of it for you. So, I wanted to say that.
Thank you. Thank you. We have a few more minutes. I'm going to take a couple more questions, and then we're going to wrap up. Amy?
Really important, I can say, just to piggyback on what we said, just so you guys know, even if you have someone now, there's a time I was like a hometown CPA where I grew up the first year of my business, and it got to a year where they're like, you owe 30 grand. We just said after me, they're like, you did your taxes, you owe 30 grand. And I had the 30 grand because that's all I had saved. But if I had paid it, it would have been all I had. And so I talked to someone else in this business who's like, I have a better bookkeeper, pay her grand, she'll redo them right now in a week. She did. It saved me 10 grand because she was more knowledgeable on the business and different things. So not only if you don't have one, yes. But even if you have someone where you're not sure, like we've even, in the last 3 years, we even went through it from a different CPA professional to an even different version because of the S corp that we are. It just makes a difference to have someone that's super knowledgeable. It's not just having that's really going to make a difference for you. It can really save you a lot of money, for sure.
Thank you. Thank you. I'm going to take one more question right now, and then I'm going to be around, and I'm happy to answer your questions. You've been having your hand up for a long time.
Yeah, I was just gonna say, is it more work-friendly to home office section to do like a co-working space then?
The question is a co-working space better than a home office deduction? And it depends on what your home office is like. So on an economic level, you have to do the math and figure out how much am I going to really get a deduction, right? But I'm also a fan of spending more if you're going to get more. And like, I have 5 kids, so they're young. And so even though I have a home office, there's times when I can't work at the home office because it's too crazy. And you don't want to pinch pennies. Even though we're talking about how to save money, there are smart ways to spend money. If a co-working space gets you in that like groove where you can do a lot more revenue, right? Then don't try to save a nickel when you could make a dime. Okay? Yes. Correct. So we're not CPAs. We're not going to file your taxes. We're doing the bookkeeping work and some profitability coaching for those as well. And to Amy's point, like the people who are running our business, Robert and myself, we're Cutco people. So like we know all the deductions for your business because it's the business that we know. And why we know realtors is because we work with a lot of those realtors. So I'm going to wrap up. We covered a lot of ground, okay? We talked about credits versus deductions, schedules, standard itemized deductions, qualified business income. I mean, all of this stuff, I think when I came in, most of you didn't really get this. Do you feel like you get it a lot more now? Better? Okay. I tried to accomplish my objective of giving you a stronger sense of confidence that instead of throwing your tax return away on the side and not looking at it, that you'll turn towards it and really be interested and figure out where are you inspired to do that? Some of you, yes. Okay. The last thing that I want to say is of all of the information stuff that I teach you, what really matters is that you get this done, that you file your returns and that you don't have this monkey on your back, okay? John Kane opened this meeting by saying, we care about you, right? We hate hearing people say, oh, I sold $200,000, $300,000 and I'm behind on my taxes. And I don't have any money saved in an IRA and all of those things. Like, it's great to be able to offer that service to the world, but it's also talking about a habit or talking about leveling up, right? This year in 2020, make yourself that New Year's resolution. I'm going to level up, #adulting, and I'm going to step up and I'm going to get on top of my taxes so I'm not way behind. I'm going to get this surge of energy and confidence because I'm doing what I need to do. And I wish you a lot of luck in 2020. Thank you.